Thanks for tuning in to Link Up 360, a Link Group podcast. I'm Jay Baker, Head of Industry here at Link Group. We recently launched our first ever investment trust dividend monitor, and the response has been overwhelmingly positive. So in this episode, we'll be exploring the topic of investment trusts further. Now, as our listeners will know, I'm normally joined by Lindsay Dowd, but Lindsay recently left our business to pursue new opportunities. So I'm sure you'll all join me in wishing her all the very best for the future. I've really enjoyed sharing this platform with Lindsay, so I've been having a think about who I could ask to join me to host future episodes, and I've decided to ask Victoria Keenan. Victoria is one of our account directors based in our Edinburgh office and has a wealth of experience and lots of knowledge of our industry. So I'm going to give her a call and see what she says.
Hello, Victoria Keenan speaking.
Hey Victoria, it's Jay. How are you doing?
Oh, I'm all right, Jay, thanks. How about you?
I'm good, thanks, yeah. Look, the reason I'm calling is that we're doing a podcast on investment trusts, and I wanted to see if you'd like to join me as a co-host.
Oh, I'd love to. But hang on, what do you need me to do?
Well, I've set up a conversation with two very knowledgeable guests, and we're going to be discussing trends from the world of investment trusts and beyond. The first guest is Mark Baker. He's Research Director at 5i Research, and we're also going to be joined by James Sausmarez, Director and Head of Investment Trusts at Janus Henderson.
Oh, that is interesting. I actually think I've met James and possibly worked with him before. That sounds great. I'm partnered with lots of investment trusts, so this is a conversation that I'm definitely keen to be part of.
Oh, that's fantastic. Well, let's catch up then when we record the podcast.
Thanks a lot, Jay. Chat to you soon.
See you soon. Bye. Well, I'm glad that's sorted. If you want to download our investment trust dividend monitor, you can access the link in the description. Now, let's get straight into the conversation with our guests. Right, we're live. Thank you, James and Mark, for joining us today, and of course, Victoria. Investment trusts have had a good response to the pandemic, increasing dividends in 2020, for example. So today we're going to be talking about that in more detail. But before we do, I thought it might be useful to hear from you, James, a bit about the background of investment trusts and why investors choose to invest in them.
Yes, certainly. I mean, investment trusts to start with. I mean, the important thing to remember about investment trusts is that they are a pooled fund. You're employing a professional manager to buy into a portfolio of a number of other companies. So you spread your risk across a large number of companies that are chosen by a professional manager. And it's different to what are called open-ended funds because investment trusts are actually companies listed on the stock exchange. And many of these companies have been around for a very long time. The first investment trust was launched in 1867. And the Bankers Investment Trust, which is one of our oldest investment trusts, was actually launched in 1888. And so you can see that the investment trusts have looked after the sort of investments of many generations of families. And I think that's something that counts for a lot in this day and age. One of the other advantages investment trusts have is that they have an independent board of directors. And that independent board of directors appoint the manager, challenge the manager, question what the manager's doing, and above all, negotiate the fees that the manager receives, which means that that's always something that's quite competitive. So I think that a lot of investors like investment trusts because of their longevity. They like investment trusts because of this independent governance provided by the board. They like investment trusts because they provide a good spread of risk through a portfolio chosen by a professional manager. Now, the one other benefit of investment trusts, which is very pertinent to our discussion today, is that investment trusts, because they're companies, are able to keep some of their income back every year into what's called a revenue reserve. And it's like putting money away for a rainy day. And so what they do is they can only retain 15% of their income. The other 85% has to be distributed. But they can put some aside. So in the good years, they can put money aside for the bad years. And that enables investment trusts to keep very steady level of dividends, and a steadily growing level of dividends. And it's because of that ability to be able to do that, for example, the City of London Investment Trust, PLC, has the longest track record of in the investment trust sector of increasing its dividends every year. It's increased its dividends every year since 1966. So that's 55 years, which is which is a fair old time. And for those of you who are football supporters, of course, you'll remember that was when England last won the World Cup. I suspect most of you are too young to remember that. But I certainly do remember it, and literally 55 years of increasing dividends every year. Now, this is very, very reassuring for investors to know that that's the case, and these revenue reserves have facilitated that. And I'm sure we'll come on to talk a little bit about how those revenue reserves came into play very, very effectively in 2020.
Yeah, and of course, I would imagine that was also the case back in 2008, 2009, 2010 during the financial crisis. Victoria, please carry on.
Yeah, no, sorry. I was just going to ask, James, I've heard the term dividend heroes thrown around and investment trust heroes. Is that due to the longevity of the fund and the constantly growing dividend?
Our dividend hero status is provided by the Association of Investment Companies, the trade body for the investment trust industry. And it's about the consecutive years that you've increased your dividend. So if you need to be a dividend hero, you need to have increased your dividend every year for at least 10 years. And if you don't increase your dividend in any one year, or if you hold your dividend at the same level in any one year, then you cease to be a dividend hero. So, investment trusts are very, very keen to continue to grow their dividends every year, because they want to retain their dividend hero status.
Right. So, talking about dividends, I think, and to bring Mark in, what we've seen during what's been some very challenging market conditions, Mark, over the last year or so. I would love to hear your insights into how investment trusts have been performing on the dividend front.
Yeah, I mean, it's been a fascinating year. And I think before we jump into talking about investment trust dividends, it's worth just looking at the broader context. So if we just look at the UK only over the last year, then something like 2/3 of companies listed on the London Stock Exchange actually cut their dividend last year. And overall, they fell. So total dividends fell. If you take out the kind of volatile things like special dividends and just look at the kind of steady regular dividends, they fell by 38% during those sort of pandemic quarters. And that's actually never happened in the UK before. Even after the global financial crisis, UK dividends didn't fall that much. So it's a really, really unusual year.
Wow.
Yes,
yeah.
Yes, because this time the banks were all banned from paying dividends, and oil companies all cut their dividends as well. So once you take those two out, you've actually lost quite a big chunk of what is rather a concentrated market in the UK for dividend payments. Those big companies really do dominate the picture. So it's a very bad year for UK income on its own. And if we look a bit more widely around the world, the picture is not so bad. So that if actually Janus Henderson's Global Dividend Index, it tracks global dividend payouts and showed that they were down 12% last year. And that's actually slightly better than in the global financial crisis. And I think really that's sort of testament to the sort of global diversification argument that if you're in a spread of countries and a spread of sectors and a spread of companies, you're going to be more protected against those sort of big impacts that hit any one part of the world or another, or any one sector or another. But even so, that was a big number nonetheless. You're down 12%. So what happened with the investment trust? Well, investment trusts invest in all sorts of different kinds of shares. So they have all different flavours. Many of them are focused on the UK. Many of them are globally focused. Some have a particular regional mandate, like looking at Europe or Asia Pacific. And I think James, in your portfolio of investment trusts at Janus Henderson, you have some that do really all of those things, I think. And James has touched on this revenue reserve, and that really did come into its own. So last year, the investment trusts that invest in equities in the UK, I'm not going to talk about those investing in property and some of the kind of more esoteric assets, just kind of more vanilla equity funds. They dished out about 1.9 billion in dividends last year, and that was actually up 4.2%. So an increase in dividends from investment trusts in a year when everyone else in the UK went down 38% and the wider world went down 12%. So it's a really astonishing result. And very few of them actually cut. So, I told you that in the UK, around 2/3 of companies cut their dividend last year. Globally, it's about a third. In the investment trust sector, actually 75% of trusts either held or increased their dividend last year. So really, really impressive result. I can give you a bit more information if you want on how that breaks down by different flavours, but we can get to that when you want to.
Yeah, I think that would be extremely interesting to hear how this breaks down. And I mean, if you have those details immediately available, then yeah, by all means, let's hear them.
Okay, so I think by value, the UK is about a fifth actually. Funds that focus on UK equities are about a fifth of the assets under management, while those that invest globally are around 40%. But it's not the same when you come to look at the income. So in fact, it's almost reversed. So actually about 40% of the income comes from UK investing trusts that invest in UK equities, and about a quarter comes from those global funds. And what that tells you is that UK equities tend to distribute more dividends than companies in other parts of the world. So that had an impact last year in terms of what investment trusts could actually distribute. So we saw UK funds increase their dividends by 3.8% last year, which is pretty good. Remember that the overall UK equities were lost about 38% last year. But the global funds did even better, and they increased their payouts by 9.3%. So a really chunky increase in a year when global dividends were down about 12%. And again, that is a testament to this really strong diversification inside these portfolios, and of course this famous revenue reserve. So there were some weak spots. Trusts investing only in Europe were those that probably did worst of all. Europe's a bit unusual. Companies in Europe tend to pay one dividend a year. In most parts of the world, you get at least two. Some parts of the world, you get four. But in Europe, it's all one hit. And the pandemic kind of struck with its full force right when European companies were about to pay their dividends this time last year in the second quarter. So I think it was quite natural for investment trusts that were focusing on Europe to say, well, we need to be a little bit careful. We've literally had the income rug pulled out from under our feet. So those were more likely to cut. So European trusts saw their dividends go down about 18%, and 3/4 of the European focused trusts actually cut their dividends. They really did stand out. But, emerging markets trusts did very well. Japanese trusts did very well. And overall, I think the sector, I think the investment trusts really showed why they matter and why they differentiate themselves from the more open-ended funds that don't have this flexibility.
I mean, perhaps I can just comment quickly on the European trust situation. I think that one of the things you've got to remember is that some investment trusts have an income mandate, some investment trusts have a sort of capital mandate. And then you look at them in a total return basis as well. And the investment trusts with an income mandate would have been very, very focused on making sure that their dividends, were at least maintained and possibly increased by using the revenue reserve. In the case of European specialist investment trusts, they are not generally income focused. They're generally capital or total return focused. And I think that it would be fair to say that the pandemic gave those trusts the opportunity to look at their total return and reconsider the level of the dividend they're paying. Because at the end of the day, the shareholders weren't buying it for income. They were buying it for total return. And therefore, I think those boards took the opportunity, if you like, to restate their dividend or reposition it at a slightly lower level, which then enabled them to manage the portfolio for a better total return. So there were other factors that affected the European Investment Trust, is what I'm saying, not just the reduction in dividends in Europe.
Yeah, that's a really good point, actually, James. And I think this kind of why waste a good crisis in a way is, and I think it's not just something that the investment trusts that you mentioned have seen. I think a number of the actual companies, underlying companies, are doing the same thing, and a kind of wholesale review of dividend policies has taken place in quite a lot of parts of the world. and probably is going to result in healthier dividend policies for some of the companies. Shell's a good example, that were arguably really over distributing in the past. So, I think that is a valuable thing.
Yeah, and I think the other thing I would say is just put yourself into the shoes of the investor. If you're a retired person who is investing for income because you want to supplement your pension to live comfortably in your retirement, what you want is stability of your income. You want to be able to get those dividends in, for those dividends not to be cut because you're spending them. And therefore investment trusts really came into their own there, because they can absorb this bad news out in the market when the underlying companies are cutting their dividends for whatever reason. Keep the dividend, at the level it's at, or even increase it using their revenue reserves, and then as things settle down, go back to normal, have a few more good years, top up the revenue reserve again. So, if you're an investor, investment trusts really do provide you with that comfort that dividend's going to come in. And, as you can imagine, nothing's guaranteed. You can't guarantee that these dividends will continue. But, you've got to be pretty sure that if a company like City of London Investment Trust has increased its dividend every year for 55 years, it's going to try extremely hard to make sure that they keep doing it, because that's not a record you ever want to lose.
City of London is also the biggest dividend payer in the investment trust market, isn't it, James? I think it was something like 90 million pounds it distributed last year. It's an enormous amount of money.
Well, it did, but that's because it's quite a big trust with an income mandate. I mean, it's about 1.6 billion in size, so that's why the dividend is a fairly big proportion. But it's not one of the highest yielders. I mean, Henderson Far East Income at the moment is yielding sort of 7%, and so is Henderson High Income. So there are trusts that are yielding more than that. But again,
the point.
Yeah.
Sorry, James. I was going to say the point you made about the pensioners, being worried about whether their income was going to be sustained, really rang true to me when I was. My mother was reading the linked dividend monitor in the Telegraph, I think, and lamenting how she'd noticed their income falling from their savings, except the savings they had in investment trusts, where she said that those dividends were holding up. So, it's precisely that value that I think in that little homespun example did seem to shine through.
James, so can I put you on the spot slightly? I was going to ask, especially in City of London, which mainly goes into UK equities, and yes, they've got these reserves. But given the pandemic's gone on longer than we imagined, how long do you think the reserves for companies like City of London can actually last to give the good returns?
Well, I mean, what you need to do is you need to, look at what they call the company's dividend cover, and that is the amount of reserves they've got that can pay the dividend. So a trust like City of London has got sort of pretty much just over half. I'm not quite sure the exact figure is at the moment, but I know it's got over half of the total annual dividend in reserve.
Incredible.
Now that's a phenomenal amount, because although dividends have been cut, they haven't been taken out completely. Dividends are still being paid. So what the revenue reserve is doing is just topping up the dividend to get it to the level that the board want to declare and the shareholders are expecting. So you can run for quite a few years dipping into your reserves before you have a problem. And certainly this year is looking like being a better one for income than last year, as companies start to come out of the pandemic. So, we're expecting a smaller call on the revenue reserve this year, and then perhaps next year we'll be back contributing to it again. So I think most companies, investment trusts, have built up quite a good reserve. There's always a bit of a debate amongst investment trust aficionados like myself about what the optimum level of revenue reserve should be. Should it be 1 year's dividend, or more than that, or less than that? But I think 1 year's dividend maximum is a reasonable level, because that will give you some comfort for a number of years if there's a prolonged rainy day.
Yeah.
I think the other thing to point out is it's not a static portfolio, is it, James? So the fund managers will also understand they have an income mandate and will rejig the portfolio to upweight those companies where they expect to see dividends maintained or continued. I think this is one of the things that the Janus Henderson Global Dividend Index pointed out, is that actually, we should remember that the vast majority of global dividends were still paid last year, and most companies did not cut. So there was still quite a large pool of quite happily dividend-paying companies out there for trusts to invest in. So it isn't sort of...
Yes, I mean, I was just going to say that's where investment trusts do come into their own, because the investment trust, manager is a professional manager, and what you want is, you don't just want the income, you want the income paid from companies that are growing as well. I mean, you want a good total return as an investor. You don't want your capital falling in any sort of way. So the manager, would look at it and would invest in the companies they think are going to provide the best total return as well as the income. So, that's where professional managers, really come into their own, and why people buy investment trusts rather than sort of try and pick equity stocks themselves.
I was going to say, we're going to see if James remembered that one of the trusts that he, in his stable, Henderson International Income Trust, did some research about 2 years ago, I think, on global yield traps. So looking at companies around the world that are considered yield traps, which means where they might pay a nice dividend, but actually that dividend might be under threat because it isn't sustained by the kind of outlook for companies. And the trust manager pointed out at the time that what you want is companies that are paying a healthy dividend, but a sustainable healthy dividend, and ideally a dividend that can grow over time. And when we looked at the stocks that ultimately did cut their dividend when the pandemic hit, which we didn't know was going to happen when Hint did its research in the first place, those yield traps were significantly overrepresented in the companies that had to ultimately cut. So it is a really important point that these active fund managers have the opportunity to make judgment calls to find those companies that are going to provide the best sustainable and growing income to their end investor.
Yeah. And I mean, that as well leads perfectly into my next question, which, what does the future hold for investment trusts, and what are the learnings that can be used to predict what the post-pandemic world might look like, and are the asset managers and fund managers taking a more active role in the governance of their investee companies in the future with regard to ESG and the rest of the language that we're hearing at the moment? So that's an open question to everyone, really.
Yes, I think that the comment I'd make is that ESG, environmental, social, and governance issues, is becoming a very, very important factor in investment. And I think every investment trust and every fund is looking at its ESG credentials and explaining how ESG is forms part of the investment process. So, investors should look out for that. They will find, I think, information about the ESG approach of the fund managers that manage any investment trust on their websites, and I think that it's generally always a very good read. But it is a very, very important thing, and I think that all of our fund managers take account of ESG factors, and they do question companies about what they're doing in an ESG sense, and these companies are challenged, and quite often the companies that get the best score, if you like, in terms of ESG, are often the ones that are most attractive, which says a lot just in itself.
Absolutely.
I think that's a really interesting point, because I think 20 years ago when ESG people first started talking about it, and it was very much a fringe thing, I think it was always assumed that it must come with a penalty in terms of your return, and I think the evidence is increasingly showing that that's not the case, especially over the longer term, because of all the kind of negative consequences of bad corporate behaviour, whatever it is, that ultimately harm the environment or the society or the shareholder one way or another. James, do you think that ESG might be a category that ultimately makes itself redundant if fund managers like yours and those elsewhere across the sector basically demand that companies behave appropriately? The category itself may just become what we think of as fund management now.
Well, I think that we're a little way away from that. I think as it stands at the moment, because, there's different levels of ESG. I mean, there's companies that just, take account of ESG. There's companies for whom ESG is one of a number of hardline factors in their investment objective or investment policy. And then there are ESG funds or sustainable funds or funds that their investment objective is out and out ESG compliance, and they're known as dark green, and the middle category is light green. So, I think there will remain those sort of distinctions will remain for the time being. And I think we're a long way from ESG being completely embedded in every single investment portfolio across the world and embedded into every single company that those fund managers would invest in. So I think, we're on a journey, and we're a lot further down that journey than we were 10 years ago, hell of a lot further. And I think the pace of change is accelerating, and we're seeing it accelerate, and the regulators are encouraging it. So, I'm very optimistic that in 20, 30 years' time you might be right, but you're not going to be right this year or next.
I think we'll invite you both back for another conversation podcast on ESG, perhaps in the next few months, because it's receiving, as you well know, an awful lot of attention from not only the issuers but from investors too, and rightly so. So, if I can, just to start bringing this to a close, just a few closing remarks from you both on where you see the dividend returns and or the future of investment trusts over the next 5-10 years. And I'll go to you first, James, if I may.
Well, yes, of course. I mean, I'm very optimistic about the future for investment trusts over the next 5-10 years. I mean, particularly in regard to private investors and in retail private investor investing. That is to say, private investors who are making their own decisions. We've seen a significant increase in interest in buying investment trusts over the last year. One of the few good things you can say about the pandemic is that people have A, had more money in their pockets because they've been able to spend it, and B, more time to think about what they might do with it. And as a consequence, we've seen a lot of these private investors start to look at investing and thinking about it for the first time, asking questions, Googling it and spending time looking at podcasts and other things that are available to them. And I think, particularly when you bracket that with all the changes to the pensions legislation that's gone on over the last few years, and the fact that people can take control of their own pensions and their own pension decisions, I think we're going to see a significant amount of interest growing, over the years ahead in investment trusts. And the mainstream investment trusts, like City of London, Bankers Investment Trust, etc., are going to be increasingly owned by private investors. Yeah. And I think this is a big opportunity for the investment trust industry, and we need to take it.
Wonderful, yeah, absolutely wonderful. Mark, do you have anything to add on the dividend side, based on the research you've conducted?
Well, I think, funnily enough, my point it sort of follows on from James's, which I think is that investment trusts sometimes sort of people think they're more complicated than they are, but I think they're actually the most simple way of buying an investment fund. We've already shown through our discussion that they provide an extremely reliable and regular income stream, which is very helpful for many kinds of investors. But even those for whom growth is more important at their stage of life than income, there are plenty of trusts to choose from. And all you have to do is buy a share on a stock market. You don't have to go through the more complicated process of getting into the open-ended fund system, usually through platforms or advisors or whatever. You can just buy them. So I think, and they're cheap to buy too, the low transaction costs. So I think it's a simple product usually with a very clear investment mandate and a reliable income stream, and that feels like a win-win-win for a private investor.
Indeed.
Oh, I absolutely agree, Mark and James. I actually was thinking about during this conversation, especially when you, Mark, brought up your mother reading about her dividends have gone down, that absolutely it does seem like investment trusts could be very much the future for a lot of individual investors if they're wanting that long-term return when things like the pandemic and stuff had come about that nobody expects.
Absolutely, and you're protected against individual stock movements. So I mean, if for example, a few years ago, the oil companies got into trouble. Before that, the banks, and suddenly these companies suddenly have something goes wrong, something happens, and that's a real problem if you own shares in that company. But if you bought an investment trust and that just happens to be one investment out of 100, it hardly notices. So that spread of investment to lower the risk of your investment makes a big difference.
Yeah. I think that's a positive to end on. Well, I think that wraps up our conversation very nicely. Many thanks to both James and Mark for providing such valuable insights for our listeners, and thank you to our listeners for joining us.
Well, thank you very much to James, Mark and Jay. I thought that went really well. If you've enjoyed today's episode, you might want to consider hitting subscribe on whatever platform you get your podcasts. That way you'll never miss us. Both myself and Jay are on LinkedIn, so if you want to connect with us, we'd love to hear from you. You can also follow the Link Group page on LinkedIn for regular industry updates across the globe. Thanks again for tuning in. Until next time.